Hello, everyone. Welcome to the Ease into Retirement podcast. I'm Tom Mosley, your host, and I promise you every time that if you'll give me up to 15 minutes, I'll do my best to build your financial knowledge. Now, we give you general financial recommendations, advice, information every single podcast, and that's our purpose. We want to build a general financial knowledge base for anybody who listens to podcast 1 through, this is number 9. This is the first part of a 2-part that we're going to do. But our goal is to do this. It's general. It's not specific. And by that, I mean this. Everything that we put out, you cannot take that as specific tax, legal, or investment advice for you. It is general knowledge. It's never intended to be considered specific tax advice or legal advice or any kind of investment advice that you should go do right now. Now, the only way we can determine, you say, well, what is it then? Why is it not? Because it's like if I had the plans of a really beautiful home. Now, I grew up in Georgia, really close to the fall line. Now, I don't know if you know what that is, but from the shores of Georgia's coastline, there's sandy, there's red clay, and then you get to about Dublin. And if you're south or southeast of Dublin, it's flat farmland, sandy, some rocky clay. But if you go north on 441 from Dublin, and you get about 2 miles out of town, you start hitting hills and they start rolling. That's called the fall line. It's where the mountains, it's where the hills begin and that soft, flat land goes away. And what I'm trying to say is it's entirely different. It's entirely different. Now, if I were to give you the plans for a house, if you were to build it 10 miles southeast of Dublin, or 10 miles due north of Dublin, it would have to probably be completely different plans because north of Dublin, you're going to have to probably put it on a hill. South of Dublin, you're probably going to put it flat. And that's what I mean by when we pass out advice, it's a generic tax, legal, or investment advice. But when it gets to you and you start applying it to your particular situation, that's where you got to know the landscape, and the landscape is what you bring to the table. In other words, some people come to us and with their 2 Social Securities if they're married and with a pension and maybe with rental property, they don't need any income. And so they really don't have a pertinent need for a fixed indexed annuity unless they're putting money away that's secure, that'll never go backwards, they'll never lose, they're going to make about 4 to 5% a year. So you got to know why and what a person needs. And that's why you can't give generic advice. Maybe I go a little bit overboard, but I just want you to remember that as we go time to time to time. Now, today's topic is, stick with me here. You might think you know what I'm talking about right off the bat, but you might not really get it yet. Today's topic is 2 becoming 1. And you say right off the bat, you say, oh, I know exactly what that means. You're talking about when people get married, and it could be. I've done a lot of weddings, over 3,000 weddings. Check it out. I'm in the Hall of Fame for the Knot website for officiants in Southern California. And Mark chapter 10, verse 8 states, and 2 will become 1 flesh, so that they are no longer 2, they're 1. And so there's a lot of books even written about 2 becoming 1. And it's the story of people when they get marriage. Now, as joyous and as happy as weddings are and marriages are, where 2 become 1, today I want to focus on the other end of life. Because if you're married, the chances are very, very likely that at some point, one of you will pass away and leave the other. 2 again will become 1, and there'll be just one of you left. Now, if you're single, you say, well, I can turn this podcast off because nothing's going to apply to me. Well, the good news, bad news is if you're single, you're already there. You're already alone in this, and you're already by yourself. Those of you who are married, you just got the assumption always there'll be two, but there will likely come a time when there will be just one. Now, in your mind, if you're one of our clients, if you don't know what the financial house looks like, then you need to email us. Email me at tom@easeintoretirement.com, or better yet, email Jill at easeintoretirement.com and ask her for the financial house, because that's a drawing we have that touches on all of the areas: income, inflation, investments, taxes, healthcare, and legacy that you need to address if you have a total, complete financial plan. What I'm going to do today and the rest of the time on this podcast is I'm going to start going through those 6 things and show you how at the end of life, when you're married and 2 become 1, you're by yourself again, or if you're single and you're just one all along, how it's going to impact you, and it's going to impact your financial life. Okay? So here we go. If you're married and a spouse passes away, well, you say, well, all of my bills will go down to just half because there'll be just one of us. Well, tell your mortgage company that. Tell your car loan people that. You just go to them and say, yeah, my wife passed away, and so I'm just going to make half the payment from now on. Nah, it's not going to work. It's not going to be that way. What statistics show is generally it's in the range of, and I've seen this as low as 75 and as high as 90, but in general, the range is to maintain the household when 2 become 1 at the end of life, and there's one of you left. It takes about 85% of what it took when there were 2 of you to run the household. So you got to back up from that and say, what is our landscape? What was our situation? Were we in the hills, or were we in the flatland? In other words, was my spouse who passed away, were they still working? Were we depending on their income? Were we depending on their employment, not just for the income they were bringing in, but if you were under 65, were you depending on them for your health care? Now, you'll get a chance to COBRA for a few months, but those are considerations that change when 2 become 1. Where's our income coming from? You say, well, Social Security, let's talk about that. Many times, most times, almost all times, people have 2 Social Securities coming in, unless you work for a governmental agency and you didn't qualify for Social Security. Most of the time when a married couple in retirement, they're going to have 2 Social Securities coming in. Well, the good news is you get to keep the larger one. The bad news is you lose the lower valued Social Security. So,
hey folks, thank you for listening to today's episode of the Ease into Retirement podcast with Tom Mosley. Just a quick reminder that if anything you've heard so far today has hit home for you, maybe it's something you're dealing with, maybe it's just something you want to learn a little bit more about, there will be a complimentary downloadable giveaway on Tom's website specifically prepared for this week's episode that you should check out. Just go to easepodcast.com. That's EASE podcast.com. Click the button with the title of this week's episode and get your copy today. Now I'll throw it back to Tom.
If the breadwinner, the one who was bringing home the most Social Security, passed away, the one who's the non-breadwinner is going to bump up and start bringing home what the Social Security breadwinner was bringing home. But they're going to lose the smaller amount. So you need to consider that. Pensions, there's something else. If the one who passed away had a pension, how was the survivor benefit taken? I know some people I actually had a guy one time, I love stories, never any names, but I had a guy came to me one time and he said, Tom, that's good. I retired 2 months ago and I didn't want to bother you before I retired. I wanted to come make a bunch of decisions and then see what I could do with what I had done. In other words, he wanted me to give him a stamp of approval that all the decisions he'd made the first time he ever retired, had all been right. And you got to understand, in 26 years of doing this business, I've literally retired with hundreds of people. And so I know some of the pitfalls and some of the mistakes you can make. First thing out of the box, I asked him, I said, so you worked at Boeing. What did you do with your pension? Well, I got that pension declaration, and man, that number at the bottom that was really big. I took the big one. I took the one that it says only on my life, okay? Only on the beneficiary's life. And there was nothing left to the wife, okay? So he had made his decisions and then come for advice after he made his decisions. Not really a smart move. And he had made a decision that if he passed away, his wife would get nothing from his pension. It would be all going away because he could make, I think it was $247 a month more. So you got to go back and you got to look and say, how's my pension taken? If I pass away, does my husband get my full pension? 75% of it, 50% of it? What do they get? Another source of income in retirement that many of our people have is rental income. We just recently had one of our great clients take out $400,000 of our investments with us, and he bought a duplex in Arizona. And that's a good thing because a lot of people have significant income from rental properties. Now, here's the question on rental properties. If the person who passed away in the marriage was basically the engineer of the rental properties and the person who did all the repairs and the person who dealt with the people whenever there was something empty and they got the new person in there and they collected the rent. In other words, they had the rental property all in their hair and it didn't bother them. They actually enjoyed doing it. Well, that's good. But what happens if the spouse who's left doesn't want anything to do with the rental properties? Well, the good news is you could sell them if you want to. Another good thing is you could hire somebody to do all of those things for a fee. But many times I've found that when two become one at the end of life and a married couple becomes one, or when a single person has rental property and they just get to the point in their age where they say, I don't want to deal with it anymore, and they want to sell the property. Well, the income's going to change. The good news is you have the asset to sell, but income is going to be impacted when two become one. Remember Muhammad Ali, one of my favorite quotes. It's not the punch that I expected that knocked me out. It's the punch you don't expect. So just be aware of some of these things. Now, if you know our house, right above income is inflation. Inflation, how are you going to deal with inflation? Good news is Social Security is somewhat indexed for inflation. It never goes up as much as we think it should. That's good. Pensions, what I see is I would guesstimate, total guess here, but about 75% of the pensions out there don't have a cost of living raised to them. Rents, if you've got rental property, rents generally stay up with inflation. Again, you don't have to have an inflation factor built into everything. Most things do. But if you don't in a pension, and that's the mother lode of what you're getting in retirement, you just need to know about it so that you can plan for it before that day comes when two become one. So let's move on up to the middle of the house if you know our house investments, and I'll start talking about that. Number one, when somebody passes away, often there's a life insurance benefit. You need to know how life insurance comes. Life insurance goes to the declared beneficiary on the policy, or if both of you pass away at the same time, life insurance goes to the declared contingent beneficiary on the policy. That's why both the beneficiary and the contingent beneficiaries need to really be kept up to date. But the good news is that life insurance benefit goes tax-free. A lot of people have $15,000 death benefits, and basically that's there to cover the funeral and the final expense. Some people have a $50,000 policy. Some people have a $100,000 policy. Last month, unfortunately, back in the fall, we had one of our great clients pass away, and the surviving spouse, the one who was left when two became one, contacted me and said, I've got about $250,000 in life insurance. The good news is that's tax-free. What are you going to do with it? How are you going to invest in it? Do you need to pay the house off? Do you need to lower your monthly expense? Do you need to invest that? All kinds of decisions have to be made when two become one, and there's a life insurance benefit. And I've already mentioned this a little bit, but be sure and check out how your beneficiaries are listed, because we have people sometimes bring their policies in and their beneficiaries have already passed away. So you need to make sure. that you're noting that. And the second thing is that I would mention here, and then we'll take a break and come back next week and talk about the rest of investments, and we'll talk about taxes and healthcare and how that impacts you when two become one. But the second thing is your bank accounts. Be careful bringing a child, one of your children on, or more than one of your children on as a signer on your bank account, because they then become an equal partner with you on your bank account. They have access to it. It could impact your ability and their ability to borrow money. It could impact your credit report, all kinds of things. There's a way, and it's called taking out a TOD. That's transferable on death or payable on death, a POD. And most financial institutions will allow you to attach as a TOD or a POD onto your account when there's just one of you left, so that the child you pick or the children you pick, after your death, 3 or 4 or 5 days maybe, they can produce a death certificate from the county, and that bank or that institution will sign your assets over to whomever you've declared as the person to whom those assets are transferable on death or payable on death. But please be careful about putting them on as an actual signer or as an owner of the account. Another story, 5 years ago, 6 years ago, 7 now, time gets away from you. But I had a lady came in and she said, I got some bad news, I've got cancer. Well, that's not good. And she was a very, very small account with us, and a pretty sad situation in that way. And she said, and I had some money in the checking account, and they've told me I need this drug to treat my cancer, but Medicare won't pay for it because it's a specialty type drug. And I went to my bank account to get the money, and I had put my daughter on as a signer on my bank account. And unfortunately, Tom, I found out my daughter had already spent the money on drugs, but not cancer drugs. She had used the money for her own drug habit. So be really careful bringing them on as a co-signer or as another signer on your account. They have access to your assets before your death. Make sure it's, you got to you say, well, I don't mind them having the money. Look, take care of the goose that laid the golden egg. You're the one that's going to leave them the money. You need to take care of yourself when you're in this life. And then after, put that TOD or POD on there. And after you pass away, they'll be able to access your assets in a totally legal way. Hey, listen, we're at the end. First half. Next week, we're going to do the second half in podcast 10, but this is podcast number 9. Remember, if you need to reach out to us, you can go to Ease Podcast, that's EASE podcast.com. You can call us at 714-421-4288, or you can email us at tom@easeintoretirement.com. So until next week, this is Tom Mosley signing off, and I promise you, if you'll give me 15 minutes, I'll do my best to build your financial knowledge.
Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Mosley Insurance and Financial Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Mosley Insurance and Financial Services is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Mosley Insurance and Financial Services.
A Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.